Are you concerned about what's happening in today's economy? Are you looking for some insights to help protect your retirement? Well, stay tuned to the end of this video because I'm interviewing one of the #1 authorities on retirement, Tom Hegna. Well, thanks so much for joining me today. I'm so excited to have my guest and one of the leading experts in retirement, one of my favorite economists, Tom Hegna. He's a best-selling author of Paychecks and Playchecks, Don't Worry, Retire, Be Happy, and one of my favorite white papers on retirement. Tom, thanks for joining me.
Thank you, Daniel. Great to be with you.
Yeah, I watch your economic commentary every year, Tom, and this year was a lot longer than normal, and there was a lot more that you packed in there. It was really exciting. Can you tell me what is the data showing that people need to be paying attention to right now?
Well, I always like to keep the main thing. And to me, the main thing is that our country's now over $31 trillion in debt. And it's not just the debt that's the problem. The real problem is the interest on the debt. And, when interest rates were 1%, well, 1% of $31 trillion was $310 billion. I mean, that's a lot of money, but we're a big country. We can afford it. But at 5% interest, that's 1.5 trillion. And we know the 31 trillion is going to stay at 31 trillion. When that hits 50 trillion at 5%, that would be $2.5 trillion just on interest on the debt. Now, to put that into perspective, our entire military budget is $800 billion. Our entire Social Security budget is $952 billion. So, it won't take long before this interest is going to take up more than our defense and our Social Security combined. And that's what's super scary. And that's why I think the Fed just has to keep raising rates, because they gotta break inflation so that rates can come back down, or I think we're really doomed as a country. We can't afford to pay this interest.
A lot of people are saying rates have topped and they're going to come back down. How much higher could rates go right now, Tom?
Well, I mean, I don't know, but I think they're going to go higher than what the market thinks. The market thinks they're going to stop at, 4.75 to 5.25 or something. Then the Fed says, well, we might go as high as 5.5. I think they're going to have to go higher than that. Every time you see the stock market rallying, that's inflationary, and that means they're going to have to raise more. So the more that the stock market rallies, the more work they got in front of them. And so, I just think they've raised interest rates so fast, and we're only down to like 6.4%. The Fed wants to get it down to 2%. Well, how much higher are they going to have to raise it to get it down to 2%? There's some people who say they don't think they can get it down to 2% without throwing, tens of millions of people out of work. So I just think it's a really tough time, and I don't think the Fed is going to pause. I don't think they're going to pivot anytime soon. They've even said we're not even thinking about pausing or pivoting. And so I just think the market has it wrong. I think rates are going to go higher. They could go over 6%, could go over 7%. I don't know. I'm not calling a number, but I just know that they're going higher than what the market thinks they're going.
Yeah, in your economic commentary, you talked about the concern of zombie companies, and you brought that idea to light for a lot of people that hadn't heard of that before. What is a big concern with these zombie companies, and can you elaborate on that chain of unintended consequences?
I think the slide was that 24% of the Russell 3000 companies are zombies, which means they can't even pay the interest on their debt. They're not making enough money to pay the interest on their debt. Well, I mean, that's like the federal government. We could say we're a zombie country right now because we're barely able to pay the interest on our debt. The only way we do it is by borrowing. And so, I mean, what you're going to see, you're going to start seeing bankruptcies. There's just a slide that came out this morning that large bankruptcies are the highest they've been in a decade. So some big things are going bankrupt, and you're going to see, people go bankrupt. You're going to see a lot of businesses go bankrupt. That's part of the pain. When the Fed says there's going to be pain, that's what they mean. People are going to get laid off. People are going to get fired. The companies are going to go bankrupt. Investors are going to lose money. He needs your 401k to go down so that you spend less money. You feel less wealthy. See, he's got like a sledgehammer, and he's taking a sledgehammer to the economy by raising rates. And we could use a scalpel, might work a little better, like to get gas prices down. What's Powell supposed to do? Throw a bunch of people out of work? It'd be cheaper and quicker to just drill more oil. That's the solution to that. But politics being what it is, that's not happening.
What do people need to be concerned about in regards to China right now?
I'm very concerned about China. They just had their China Congress last fall, and Xi Jinping got reelected, probably basically for life, but for at least another 5 years. He got rid of all the moderates in the session, and you saw the slide where he did it in public. He had people escorted out of the session who were moderates, and he surrounded himself with generals that are hawks on Taiwan. And we just declared a chip war on China, where we're not letting any company sell high-end chips to China. Even Taiwan Semiconductor in Taiwan is not allowed to sell high-end chips. And so I'm saying, why wouldn't they just say, hey, let's go overtake Taiwan? Now, I think the fact that Russia's having big problems in Ukraine is making them think twice about it, because it wouldn't just be China and Taiwan. I mean, we get in there, Japan would be in there, South Korea would be in there. They'd be getting, a lot of missiles from a lot of places, and it wouldn't be good for either country if they did it. But I am concerned. Just keep an eye on China.
Yeah, there's a lot of speculation right now, Tom, and I'm wondering, you're so good at simplifying things for my viewers and people that watch and are preparing for retirement. Can you just play out a scenario for us? Like, what's the scenario that's looming, that's we're heading towards it, people who are preparing for retirement should be concerned about right now?
Well, I mean, I think the major thing is, because of this debt and the interest on the debt, taxes are going to have to go up. Because are they going to cut Social Security? Are they going to cut defense? I don't think they can cut a lot, because we're going through stuff. So the only other thing is you got to raise taxes. And I'm convinced that taxes are going to have to go up a lot. And so I have been converting my IRAs and 401ks to Roth. I've moved more of my personal wealth to cash value life insurance. I own 11 annuities. Most of them are in Roth IRA income annuities, so they'll give me tax-free income for the rest of my life, and then I'll be able to take out tax-free income for the rest of my life out of my life insurance policy. I think having multiple sources of tax-free income in retirement is one of the best things that you could do to set yourself up for success. And all your neighbors who still have their money in IRAs and 401ks, they're going to be some wailing and gnashing of teeth, because the government's going to come after that money and take a lot more than what people think.
That's so insightful. Tom, a lot of people are buying gold and silver in droves right now. When should a retiree be considering gold and silver, and how much should they buy?
If you look at it, gold hasn't been that great of an inflation hedge. It gets a big, everybody says, oh, in times of inflation, buy gold. Well, gold hasn't really done a lot. I own a little bit of gold. I own a little bit of silver. I do. But it's less than 5% of my portfolio. It might be 1% of my portfolio. I don't know. I really leave that up to the individual. I'm not going to be pushing people towards or away from gold or commodities. I just say, Warren Buffett doesn't invest in gold, and he says, it just sits there. It doesn't send him any dividends. He'd rather own Apple. That's a thriving, growing company that's sending him checks every quarter in dividends, or, so I'm not opposed to having some money in gold or silver. But, if you think about it, the pandemic, it was the biggest disaster we've seen. I mean, and what do people want? They wanted toilet paper. They wanted toothpaste. They wanted water, and so nobody's saying, oh, where's my gold? I got to get some gold. No, nobody's saying that. They were looking for toilet paper. I said toilet paper, guns, and bullets and water, in really bad times. That's what people are going to want.
Yeah, that's insightful. So what do you say to people who are like buying gold in terms of trying to think that it's going to become a monetary source again? Is it just to stock up on like useful things like commodities?
I don't see gold. What are you going to do? Take a gold bar and shave off a little bit for some bread? And, here's another couple shavings for milk. It's not going to really be a currency that I can see. I almost think that the crypto, you could make a case that if the economy start going bad, that crypto might be the place to go. But again, I wouldn't put more than 1% of my portfolio there either. So I don't know. I've just never seen a case. I used to kind of be a gold bug a little bit, probably 30 years ago, and I bought. But I mean, it's done. I mean, it goes up, go down. It's not like it's been just going up and up and up. The stock market has been a far better investment than gold over the past, 100 years.
Yeah, you address what people can do who are preparing for income. Tom, how does the scenario that you described where taxes go up and things could get really kind of ominous, how does that impact their long-term care planning?
Well, long-term care is the one thing most people forget about that can wipe them out. And so I say you got to have a plan. Any plan is better than no plan. I hope you buy long-term care insurance. I've got a unlimited benefits plan. You can't even buy what I got now because I bought it when I was 42. But if you don't buy long-term care insurance and buy life insurance with a long-term care benefit, if you have medical problems we can't get either, then buy an annuity that springs up with a bunch of income in your 70s and 80s. Any plan is better than no plan, but you got to have a plan. And for the people who think that long-term care insurance is too expensive, here's what I say. If you think long-term care insurance is expensive, man, you ought to try not having it, because that can wipe you out. It is the one thing that most people forget about that can wipe out their entire retirement.
Yeah, you talked about this idea in your economic commentary about how the 60-40 portfolio had its worst year ever, and then you were actually alluded to an article that you'd written several years prior to that about the death of the 60-40 portfolio. You introduced this idea of like annuities being a suitable place to replace bonds. Why are annuities a good use case instead of bonds for a portfolio?
Well, yeah, in 2016, I wrote the article, The 60/40 Portfolio is Dead, Long Live Life Insurance and Annuities. And all I said in that article was that why would you have 40% of your portfolio? The average person is 60% stock, 40% bond. Why would you put 40% of your portfolio into bonds that were paying less than 1%? That we know when interest rates go up, what happens to value of bonds? They go down. Why would you position yourself? I said, take that 40%. And if you're young, like you, put in cash value life insurance. You're going to get a bond-like return, but you don't have that interest rate risk. If interest rates go up, it's not like life insurance goes down. Life insurance keeps going up. If you're older, let's say like me, 60 or above, then you move that bond portfolio into an income annuity, because that income annuity functions like a AAA rated bond. It's guaranteed every single month that you're breathing, but it has a triple C rated yield. The payout rate is much higher. Many of these annuities now are guaranteed, 5, 7, 9, 11, 13% guaranteed for the rest of your life, depending on your age. And so you get that higher yield with no standard deviation. Again, when interest rates go up, annuities don't go down in value. Annuities just keep plugging away. And so, and not only am I saying it, the Wall Street Journal, the case for moving some bonds to annuities. Ernst & Young just did a study where they looked at all different investment scenarios, 100% stocks, 60/40, 50/50, and then they added cash value life insurance and income annuities. And the best portfolios contained investments, life insurance, and annuities. So, Dr. Roger Ibbotson did a study that said fixed index annuities have outperformed bonds for the last 40 years and are likely to do so for the next 40 years. Barclays came out saying that fixed index annuities are a great substitute for bonds. BlackRock, that is over $7 trillion on the stock market, said fixed index annuities have a role to play in both accumulation and distribution. So the research is out there. It's clear. Bonds were not the place to be. The bonds might be a good place for the next 2 or 3 years. As interest rates go down, then the value of bonds will go up. But again, once we get back down to very low interest rates, I would stay away from bonds.
If somebody's not taking action right now, Tom, and they're maybe a couple years away from retirement and they're just kind of staying status quo and watching what's happening, what would be your message to them right now?
I think it's dangerous not to do anything. I would just put some protection in my portfolio. People think that the older you are, the riskier the market is. That's not true. The riskiest time in the market is not when you're 87. The riskiest time is when you're 57 to 67. See, it's right before or right after retirement that you don't want to lose any money, because if you lose money in that box, it can devastate your entire retirement. So I would say definitely, if you're a baby boomer, you want to put some protection into your portfolio.
Cool. Thank you so much, Tom. I appreciate it. 2 technical questions to wrap up. There's a lot of movement towards these hybrid long-term care life, hybrid long-term care annuity products out there. There's a lot of the industry going towards that right now. What are your thoughts on those hybrid products?
Well, I think for many people, they work better. Okay. And I'll just give you an example. Let's take me, for example. I have a long-term care insurance policy. It's a very good policy, probably one of the best policies you can buy. But if I don't ever need it, I don't get anything from it. Okay. It's great protection, but if I don't use it, basically. Okay. Whereas with life insurance, it does 3 things. Number one, it's an emergency fund. So let's say you move $100,000 from Bank of America into one of these hybrid life insurance policies. Well, that $100,000 is there, and most of these policies have full money back guarantee, so you can get it out if you need it. All right. Yeah. But if you don't need it, I draw a bigger circle and say, well, when you die, your family's going to get this. So let's say the 100,000 is here. 200,000 if you die, that's the tax-free death benefit. But if you need long-term care, the bigger circle. And again, you got to take these numbers off the illustration, but I always use an example. I think a 60-year-old female, 100,000 of money, $200,000 death benefit, $300,000 long-term care benefit. And again, based on your age, whether you're male or female, those numbers are all going to change, but you're going to see that one product does 3 things: emergency fund, tax-free death benefit for family, or long-term care benefit. So I think that's powerful. As far as the annuity, that really works best for people who have maybe medical issues. Oh, they've had 2 heart attacks, or they've had, diabetes, or they got something that they can't get a long-term care insurance policy. Then the annuity would be a great fit because it would give them some amount of protection.
Yeah, that's strong. Last question, Tom. There's been a lot of talk on the internet lately about IUL versus whole life. And I personally use both. I personally feel like it's about the purpose and the goal for the client. Do you care to weigh in on that? Like, honestly, how you feel about IUL or whole life? Which one is superior, which one's different, or when you would use either one?
Yeah. So, I mean, I try to stay out of that argument. I mean, I am more of a whole life guy, I'll be honest, but I've been with AAA mutual life insurance companies, pretty much when I was in the insurance business, I was with them and that was their focus. But I will say universal life policies have more flexibility. You can raise the death benefit, lower the death benefit, raise the premium, lower the premium, stop the premium. It's a lot of flexibility. But the negative on universal life is there's a lot of flexibility. So sometimes people are their own worst enemies. Whole life is a whole different animal. Whole life, it's more like a freight train. It gets going. It's just really slow. But then when that thing gets going, nothing's going to stop that. That thing's going to keep going like a freight train. All right. So it really depends. Is somebody looking for more flexibility? The IUL has more flexibility. It has the potential to do better than a whole life policy, and it's just what's more important, the potential to do better or more of the guaranteed side. And I try to stay out of it. But I will say this, people who buy whole life, they should be very committed to that. And you got to stick with it. Whole life is no good if you buy it and 3 years later you surrender the policy. That was stupid. You should have never done that. Okay. But if you keep it for your whole life, it'll be fine. It'll be good. IUL, the main thing is you want to overfund that. You want to make sure there's plenty of money in there, because inside of IUL, every year those term costs are going up. All right. And if there's not enough cash in there, it can start getting upside down, and then you got a real problem on your hands. So overfund the IUL, and whole life is really for really stable investors who stay the course. That would be my best advice.
Tom, so valuable. Thank you so much for your time, and thanks for everything you're doing, traveling the country, coaching advisors and agents all over the place, helping people to help more people. It's incredible. Thank you. Well, if you like this video and got a lot of value out of Tom Hegna's insightful, brilliant words, please take a moment and like the video. Also, subscribe to the channel. We're bringing more industry experts to you all the time. If you have any questions or want Tom to elaborate, please leave a comment. And if you have anything else you need, reach out to me personally. You can find my information down in the description. Thanks so much for watching. We'll see you in the next one.